Hello and welcome, and in this article I'm going to be talking about the Solvency Ratio Formula. The Solvency Ratio Formula and understanding solvency ratios. Within this article I'm going to be covering the following topics. So firstly, what is the definition of the Solvency Ratio Formula? Solvency problems are stressful for company directors, and I'm just going to talk about that in a bit more detail. Then going on to explaining about the Solvency Ratio Formula, including an example. Also, what is considered to be a good solvency ratio, and also be explaining about the 20% as a guide for a good solvency ratio. There are also additional solvency ratios to keep a track of. These include interest rate cover and liquidity ratios, which includes both the current and quick ratio. And finally, I'll be introducing the 5 pillars of solvency. So what's the definition of Solvency Ratio Formula? Well, according to Investopedia, it is a key metric to measure an enterprise's ability to meet its debt and other obligations. I would go further and add to that definition by saying it is also important to meet debt and other obligations as and when they fall due. The solvency ratio is a good indicator as to whether a company will have sufficient cash flow. And if a business is unable to meet its liabilities as and when they fall due, then it's deemed to be insolvent. I've experienced this as a company owner and a director of a business. Solvency problems are stressful for directors. When a company is going through solvency issues, this can be extremely stressful for directors. Directors must be aware of fraudulent or insolvent trading at all times. They must be careful not to take on debt with the knowledge that it's not going to be paid. They must keep a close eye on the company's solvency ratio, and this is key for management. But the art of great management is all about planning. So what is the Solvency Ratio Formula? Solvency Ratio Formula is actually calculated as your post-tax profits. Added to this will be any depreciation or amortization, and that net figure is divided by total liabilities. And just as a short note, total liabilities is equal to both short-term, i.e. those falling due within 1 year, and long-term, i.e. those falling due after more than 1 year. This is an example. I'm hoping that you can see this on your screen. I'm assuming you've got a fairly big screen to be able to look at the numbers here. If not, then please go to the article which you'll find on the blog on In Business, which is in-business.org.uk, and then on the blog search for probably just solvency and it should come up. The balance sheet solvency ratio for XYZ company is 30% in 2016, but in 2017 it's dropped to 11.9%. And these are calculated, so for the 2016 year the profits were just over 118,000 and the total liabilities for the same year were £395,000, which can be seen on the balance sheet if you look closely, and that is where you get the 30% from. 2017 year, the profits have dropped to just over £26,000, but also the liabilities have dropped, but not as much in percentage terms, and they've dropped to £223,000, giving you the solvency formula of 11.9%. So a company which has a solvency ratio greater than 20% is considered to be financially sound. So what is considered to be a good solvency ratio? Well, as already mentioned, a company with a ratio of more than 20% is considered to be financially sound. But whilst this metric is a good guide to solvency, there are many other factors to be considered. For example, where a business is inefficient at collecting debtors, the solvency ratio may look good on the face of it, but when in fact cash flow is being badly affected by slow paying customers. Also, the solvency ratio formula is based on profits, but we know profit is not always cash in the bank. Management shouldn't use the solvency ratio formula in isolation. So let's have a look at some other formulas or ratios that a company could look at. Firstly, let's have a look at interest cover ratio. This is something that banks are quite keen on. Interest rate cover is a company's operating income, i.e. profits before interest and tax, or in other words, another way to describe it is EBIT, and this is divided by the interest expense. An acceptable interest cover ratio is 2 or more, but banks prefer a cover of 3 or more actually. If the cover drops to below 1%, this indicates a company which cannot meet its interest obligations as they fall due. And bank borrowing usually comes with interest cover terms. And if this were the case, a bank may be considering to draw in their loans. Loan agreements usually include covenants, and one of which is usually profitability and interest cover. The other ratio that companies need to look at or consider is liquidity ratios. The first one is current ratio. This is the ratio between current assets and current liabilities. The formula to work this out is take your current assets and divide those by your current liabilities. Another one is a quick ratio, which is similar to the one above, but it only includes current assets that are easily liquid assets. So in this case, you take your current assets, take away stock, which is not easily liquid, and divide that by current liabilities, and that will give you your quick ratio. So I'd like to introduce the 5 pillars of solvency. On each of the 5 corners, we have solvency ratio, cash flow, current assets, liabilities, and profits. So let's have a look at those in a bit more detail. So the solvency ratio formula is keeping your solvency ratio above 20%. Cash flow. We've got to remember that good cash flow is the lifeblood of a thriving and healthy business. Current assets. Make sure you convert your current asset into cash or cash equivalent as soon as possible. Liabilities. Keep a tight control over your liabilities. And profits. High profits combined with converting them into cash equals a healthy, thriving business. Thank you for listening, and if you'd like to look at some of my other articles on my business blog, please go to in-business.org.uk, and example articles like entrepreneurship definition or advantages and disadvantages of offshoring can be found there. You can also find a bit more about me on my About Me page. Thank you again, and bye for now.